On the 15th of September 2008, Lehman Brothers collapsed. That day, the dominoes of global finance began to fall. 17 years later, a troubling paradox is forming. The U.S. stock market hovers near all-time highs. Unemployment remains low. Consumers keep spending. And yet, CMBS delinquency rates for office assets have spiked to nearly 12%, the highest since the Great Financial Crisis. National debt has breached $38 trillion, with interest payments now exceeding defense spending. The Shiller P/E ratio sits at 40.3, a level only seen in 1929 and 2000. By conventional logic, these phenomena shouldn't coexist. Soaring stock prices and deepening debt distress, persistent consumer spending, and rising credit card defaults. What do these contradictory signals mean? The answer lies in a simple but brutal fact. 2008 was a single-point failure. Today's crisis is advancing on four fronts simultaneously. This analysis will dissect the four interlocking crises that 2026 may face: commercial real estate, stock valuations, government debt, and consumer stress, and explain why their convergence could create a more dangerous situation than 2008. By the end, you won't feel fear, but you will understand why today's everything is fine may be the last calm before the storm. To understand the risks ahead, we need to revisit what happened in 2008. The core of the 2008 financial crisis was relatively straightforward. Subprime mortgage defaults triggered a chain reaction that destroyed the derivatives market built on those loans. The problem was concentrated in residential real estate and related securitized products. When the bubble burst, the government could stabilize the situation through massive bailouts like TARP, quantitative easing, and near-zero interest rate policies. Here's the critical point. In 2008, the Fed could cut rates from 5% to near zero. National debt stood at about 64% of GDP. The federal government had enormous fiscal space to implement stimulus programs. Today's situation is completely different. As of late 2025, federal debt has reached 123% of GDP. Interest payments alone exceed $1 trillion annually. The federal funds rate, even after multiple cuts, remains around 3.64%, far above post-2008 crisis levels. This means if a new crisis erupts, the Fed and Treasury's ammunition has been significantly depleted. More importantly, today's risks don't come from a single source. Commercial real estate, the stock market, government debt, and consumer financial stress are deteriorating simultaneously. These four domains are interconnected and mutually reinforcing. As one wealth management CEO put it in April 2025, the 2008 financial crisis was specific to subprime lending on the consumer side. This time, if you look at mezzanine debt, collateralized loan obligations, and all kinds of subprime financing on the commercial side, that's where we see problems. The debt level of the world in 2025 compared to 2008 is not even comparable. We are so much further indebted and leveraged. Let's start with the most urgent risk: commercial real estate. Several key numbers demand attention. In 2025, approximately $957 billion in commercial real estate loans are maturing, nearly triple the historical average. Office vacancy rates nationally approach 20%, with cities like San Francisco and Denver facing even worse conditions. CMBS delinquency rates have reached 7.29%, while office-specific CMBS delinquencies spiked to nearly 12% by late 2025, the highest since the Great Financial Crisis. How did this crisis form? The rise of remote work is the most obvious catalyst. McKinsey's 2023 report showed global office space demand stabilizing at about 70% of pre-pandemic levels. But the issue isn't just vacancy rates, it's that this structural shift collided with a debt maturity wall. During the ultra-low interest rate environment of 2020 to 2022, massive amounts of commercial real estate investors borrowed at low costs to purchase or refinance properties. Now, these loans are coming due in a completely changed rate environment. An office building financed at 3% in 2021 might face 6 to 7% rates for refinancing today. For properties already seeing rising vacancies and falling rents, this means cash flows simply cannot cover debt service costs. The question is, who holds these loans? Data shows regional banks hold 4.4 times more commercial real estate loan exposure than large banks. Morgan Stanley research indicates regional banks account for about 70% of the more than $2 trillion in commercial real estate debt maturing through 2025. Approximately 278 banks have been identified as vulnerable, with CRE exposure exceeding 50% of total assets. Florida Atlantic University's banking research project continuously tracks this data. They found that any bank with CRE exposure exceeding 300% of Tier 1 capital is in a high-risk state. As of Q2 2025, the number of banks meeting this threshold remains concerning. But a crucial point needs emphasis. This isn't a replica of 2008. Today's bank capital positions are generally better than then. CRE loans have lower leverage, and borrowers have more diversified debt sources. Overall, CRE loan delinquency sits at about 1.57%, far below the 9% peak following the 2008 crisis. J.P. Morgan analysts believe that if losses remain confined to office buildings and vintage malls, this won't evolve into a systemic capital crisis. The problem is, we don't yet know whether losses will spread to other sectors. If multifamily, industrial, or retail real estate start experiencing trouble, the situation could deteriorate rapidly. If commercial real estate is a basement leak, stock market valuations are cracks in the roof invisible to most people, but equally severe consequences when the storm arrives. Let's examine the numbers. The Shiller P/E ratio, or CAPE, invented by Nobel laureate Robert Shiller, currently sits at approximately 40.3. This is 2.3 times its historical average of about 17. Historically, CAPE exceeding 39 has only occurred in 3 periods: before the 1929 crash, at the peak of the 2000 dot-com bubble, and on the eve of the 2007 financial crisis. Another indicator, the Buffett indicator, is even more striking. This metric measures the ratio of total U.S. stock market capitalization to GDP. Buffett himself called it probably the best single measure of where valuations stand at any given moment. As of October 2025, this ratio reached approximately 219 to 225%, far exceeding the 115% threshold considered overvalued and the historical average of 80 to 100%. Buffett has warned that exceeding 200% means investors are playing with fire. Fed Chair Powell himself stated publicly in September 2025, "By many measures, equity prices are fairly highly valued." Other Fed officials expressed similar concerns. High valuations alone don't cause crashes, but historical data clearly shows that when CAPE exceeds 39, the probability of stock market declines in the following 12 to 24 months is significantly higher than normal. Shiller's research demonstrates a strong negative correlation between high CAPE and returns over the following 20 years. The primary force driving current valuations is the AI boom. AI-related capital expenditures contributed approximately 1.1% to GDP growth in the first half of 2025. This has somewhat offset the negative effects of tariff policies. But this raises a question. What happens if AI investment slows or expectations disappoint? A counterargument deserves mention. Some analysts argue current high valuations can be partially explained by the long-term low interest rate environment. Traditional CAPE doesn't account for changes in risk-free rates. Additionally, accounting standard changes may distort historical comparisons. Economists like Jeremy Siegel argue that 1,990 seconds accounting changes led to understated earnings, making CAPE appear higher than reality. That said, even adjusting for these factors, current valuations remain at historical extremes. And when interest rates are no longer at historic lows, previous valuation discount arguments become less convincing. If the first 2 crises are fire hazards, National debt is a foundation problem for this House. Let the numbers speak. U.S. national debt surpassed $38 trillion in October 2025. This equals approximately 123% of GDP, far above 2008's 64%. In fiscal year 2025, the federal government added $2.17 trillion in new debt, averaging approximately $68,902 per second. Even more concerning are interest payments. In FY 2025, the federal government paid over $1 trillion in interest, a historical first. This figure exceeds Medicare spending. It exceeds defense spending. Interest payments now consume nearly 1/5 of all federal revenue. The Congressional Budget Office projects that without action, debt will reach 119% of GDP by 2035, with interest payments growing 76% to $1.8 trillion. A critical mechanism requires understanding here. The more the government borrows, the higher interest rates may climb, as markets demand higher risk premiums. Higher interest rates mean greater interest payments. Greater interest payments mean larger deficits, requiring more borrowing. This is a self-reinforcing vicious cycle. Several events in 2025 accelerated this cycle. The One Big Beautiful Bill Act is estimated to add $3.4 trillion to deficits over the next decade. While tariff revenue has increased, customs duties rose 287% in the first 2 months of FY 2026. If the government fulfills promises to distribute $2,000 tariff dividends per person, this would cost approximately $600 billion annually, far exceeding tariff revenue. Why is this different from 2008? In 2008, the government had ample fiscal space to implement massive stimulus. TARP, quantitative easing, various rescue funds, all were implemented when debt to GDP ratios were relatively healthy. Today, if a crisis of similar magnitude occurs, the government's room to maneuver has drastically shrunk. Each additional trillion in bailout spending means bearing not just principal, but interest costs in a higher rate environment. This means the capacity to respond to future crises may be severely constrained. A risk signal worth watching. During April 2025's stock market turmoil, the U.S. Treasury market experienced unusual selling. The 10-year Treasury yield briefly spiked toward 4.6%. Traders called it a Liz Truss moment, referencing the 2022 UK government crisis, when irresponsible fiscal plans triggered a bond market collapse. This suggests confidence in American fiscal discipline is beginning to waver. The final puzzle piece is consumer financial health. On the surface, consumption data remains healthy. But dig deeper, and cracks are widening. Total credit card debt reached $1.21 trillion by the end of 2024. A historical record. More importantly, defaults are rising. According to the latest Fed data, credit card delinquency rates, 30-plus days, stood at approximately 2.98% in Q3 2025. In absolute terms, this remains below the nearly 7% peak during the 2009 crisis. But the trend is concerning. From Q2 2021 to Q1 2025, delinquency rates in low-income areas grew approximately 63%, while high-income areas also saw 44% growth. Research from the street. Lewis Fed reveals a deeper problem. In the lowest income 10% of zip codes, credit card debt delinquency rates have risen from about 15% in 2022 to nearly 23% in early 2025. This means in some communities, nearly 1/4 of credit card debt is delinquent. Auto loan situations are equally concerning. In 2025, U.S. auto repossessions reached 2.2 million. Auto loan delinquency rates rose across all income levels and credit score groups. New York Fed analysts note this broad-based nature is unusual. Typically, defaults concentrate among low-income borrowers, but now increases are universal. Several factors drive this pressure. Credit card APRs currently sit at 2 to 24%, the highest this century. This means even relatively small balances snowball rapidly. Meanwhile, fixed expenses like insurance premiums, utilities, and property taxes continue rising, squeezing household budgets. Another hidden factor is student loans. After normal repayments resumed in late 2024, student loan delinquency rates surged from under 1% to 13% by Q2 2025. This means millions of borrowers suddenly need to add an expense to their budgets. Consumer confidence data is also deteriorating. From August to December 2025, U.S. consumer confidence steadily declined. While consumers haven't stopped spending entirely, they're shifting toward essentials and reducing discretionary purchases. About 1/3 of Americans predict they'll have more credit card debt by end of 2025. Nearly 40% say they can't handle more credit card debt. 21% feel very stressed about their debt. However, an important mitigating factor exists. Unemployment remains at historic lows. As long as people have jobs, they can continue servicing debt, even barely. The question is, if the job market deteriorates, especially if AI-driven white-collar layoffs accelerate, consumers' debt servicing capacity would drop sharply. Now let's assemble these four pieces and understand how they form a dangerous feedback loop. Imagine the following scenario. A regional bank struggles due to commercial real estate loan losses. It begins tightening lending standards, reducing credit support to local businesses. This causes some businesses to lay off workers or close. Rising unemployment means more consumers can't pay credit card bills and auto loans. Rising defaults force banks to increase bad debt reserves, further weakening their capital positions. Meanwhile, if the stock market corrects sharply due to overvaluation, pension and 401k account values shrink. The wealth effect vanishes, consumption contracts further. Corporate earnings decline, triggering more layoffs. The government wants to intervene, but finds limited fiscal space. Each additional dollar of stimulus or bailout means more debt and interest payments. Bond markets might experience another Liz Truss moment, pushing rates higher, which in turn would intensify pressure on commercial real estate and consumer debt. This is the core mechanism why 2026 could be worse than 2008. 2008 was a single-point failure, residential mortgage market. While 2026 could be multiple points failing simultaneously, with rescue tools' effectiveness dramatically reduced. But balance is essential here. This scenario isn't inevitable, it's a risk, not a prophecy. Several positive factors exist. Overall, bank capital positions are better than 2008. Credit card delinquency rates, while rising, remain far below 2009 peaks. Many sectors outside commercial real estate, multifamily, industrial, maintain healthy fundamentals. AI investment continues providing economic growth momentum. More importantly, whether a crisis occurs largely depends on policy choices. If the government can gradually reduce deficits without triggering market panic, if the Fed can skillfully manage the rate path, if consumer confidence stabilizes, these risks might dissipate gradually rather than erupt suddenly. For ordinary people, these macro trends mean several things. First, employment risk. Commercial real estate's most direct impact may be regional banks tightening loans, affecting small and medium businesses dependent on these banks. If you work in industries dependent on commercial real estate, construction, property management, retail, restaurants, or at regional banks, pay close attention to industry dynamics. Second, investment allocation. When stock valuations sit at historic highs, this doesn't necessarily mean selling immediately, but it does mean expected returns are lower. Many financial advisors recommend maintaining higher cash reserves in this environment, diversifying investments, and avoiding excessive concentration in any single asset class. Third, debt management. In an environment where rates may remain elevated, high-cost debt, especially credit card debt, becomes more damaging. If you carry credit card balances, 2 to 24% APRs mean they grow at alarming speeds. Finally, real estate decisions. Commercial real estate distress won't directly transmit to residential markets. Their fundamentals differ, but if the crisis spreads and causes recession, residential prices will also be affected. By late 2025, nationwide home prices had already experienced their first slight decline since 2023, approximately 1.4%. Signals worth monitoring include regional bank stock price movements, whether CMBS delinquency rates continue climbing, 10-year Treasury yield volatility, whether unemployment begins rising, changes in consumer confidence indices. Economists often say financial crises are like earthquakes. We know where the fault lines are, but can't precisely predict when rupture occurs. The four risks of 2026 commercial real estate, stock valuations, national debt, and consumer stress are today's fault lines. They won't necessarily rupture simultaneously, but their interweaving creates a fragility that didn't exist in 2008. Perhaps the biggest difference is this. In 2008, the government could rescue markets with nearly unlimited credit. In 2026, the government itself is part of the risk. But this isn't a story meant to frighten you. It's a story meant to help you understand. When you understand a system's fragility, you can make wiser decisions about your career, your investments, your debt, your savings. You don't need to predict whether a crisis will happen. You only need to prepare for uncertainty. History doesn't repeat, but it rhymes. 2026 won't be a replica of 2008, but the rhyme is already forming. If this analysis helped you, please subscribe for more in-depth content. Tell me in the comments, which of these four risks do you think deserves the most attention?